7. Alternative investments for your portfolio. What's worth doing is worth doing for money. Gordon Gekko. Let's start by defining alternative asset investments. These range from real estate and precious metals to more speculative investments such as hard money loans and cryptocurrencies. Bitcoin has been a wild ride since its origin, but this hasn't halted speculators' conviction that cryptos are a developing business sector. If you have a self-directed IRA, you can invest your money in alternative assets such as real estate. There are two primary reasons to invest in alternative assets: diversity and volatility. Even though over time the stock market has yielded a reasonably good return, the stock market is unpredictable. Therefore, every investment expert will concur that you ought to have a diversified portfolio, and alternative asset investments are a good alternative. You can consider protecting your assets against inflation by buying precious metals, earning passive income from real estate investments, or earning money from making hard money loans. All these can diversify your portfolio, but you should only have up to 10% of your funds in alternative investments. Closed-end funds are a lesser-known kind of mutual fund. When investing in closed-end funds, investors know that their funds will not be available for 7 to 10 years. Private equity fund partners are the general partners, and investors are the limited partners. The limited partnership agreement details the amount of risk that each party takes along with the time duration of the fund. Venture capital investment, VC, is a type of private equity financing that is given by investment firms or funds to finance the operations of new companies that have been deemed to have high potential growth. The VCs invest in these new companies in exchange for a percentage of the company ownership and expect to obtain high returns. It should be noted that venture capital investment is highly risky and not advisable for a beginner investor. Hedge funds are alternative investments that trade with highly complex trading strategies, such as short selling, leverage, and derivatives, to obtain a higher return for their investors. Hedge funds are only accessible to accredited investors because they require less Securities and Exchange Commission (SEC) regulation than other funds. Examples of accredited investors include a bank, an investment company registered under the Investment Company Act of 1940, and a small business investment company registered under the Small Business Investment Company Act of 1958. Commodities are natural resources that originate from the earth. A few examples of commodities include wheat, cattle, soybeans, corn, oranges, precious metals, coal, cotton, and oil. Investors focus on raw materials for their manufactured products that consumers end up buying. Some of the ways to invest in commodities include investing directly in the commodity, using commodity future contracts, and buying shares in the companies that produce commodities. The best commodities in which to invest directly are those commodities where logistics are easier to handle, such as gold and silver. Real estate as an alternative investment requires industry knowledge, a specific network, and accredited investment status. The return to investors could prove greater than the return from average securities. Investors should invest in long-term rental properties, short-term house flipping, or real estate investment trusts. The latter investment is easiest to manage since the long-term rental properties and the short-term house flipping require the investor's time and additional capital input to manage and improve these properties. A real estate investment trust, REIT, invests in real estate that generates income. Most REITs have practical experience in a particular real estate sector, centering their time, vitality, and financing on that specific segment of the real estate industry. Be that as it may, diversified REITs frequently hold various kinds of properties in their portfolios. including apartment complexes, high-rises, commercial buildings, retail centers, self-storages, warehouses, and distribution centers. One advantage of REITs for investors is that REITs give the chance to own a portion of the real estate that generates dividend-based income. The main business objective of REITs is to lease space and collect rents on the investment properties and distribute that income as dividends to investors. Equity REITs are the most widely recognized REITs. The equity REITs purchase, own, and oversee income-producing real estate. Their income comes basically through rents and not from the reselling of the portfolio properties. Mortgage REITs lend money to real estate owners and operators. The loaning might be either directly through home loans and advances or indirectly through the acquisition of mortgage-backed securities. Hybrid REITs hold both physical rental property and mortgage loans in their portfolio. The following are the various types of REITs and the nature of their holdings. Equity. Own and operate income-producing real estate. Mortgage. Provide mortgages on real property. Hybrid. Own properties and make mortgages. Publicly traded. Listing on a national exchange. Publicly non-traded. Registered with the SEC but not publicly traded. Private. Work only as private placement investments. Publicly traded REITs offer shares that list on a national securities exchange, where they are bought and sold by individual investors. They are regulated by the U.S. Securities and Exchange Commission, SEC. Public non-traded REITs likewise are registered with the SEC, but don't trade on national securities exchanges. Thus, the non-traded REITs are less liquid than REITs that are traded on the open market. But non-traded REITs are not subject to daily market fluctuations. Private REITs are not registered with the SEC and don't trade in the stock markets. Therefore, there is little to no public or independent performance data that investors can use to track their investments. REITs can have a significant influence on an investment portfolio. Similarly, as with all investments, they have their advantages and disadvantages. REITs are easy to buy and sell, as most trade in the public exchanges. This attractive component mitigates a portion of the downsides of real estate. Often, real estate lacks transparency, and the property can take time to buy and/or sell, depending on tax considerations, zoning, and market conditions. REITs are regulated by the SEC and must file annual audited financial statements. REITs don't offer much capital appreciation. They must pay out to the investors 90% of their income, and the remaining 10% can be reinvested to buy new property. The dividends received from REITs are taxed as ordinary income, and REITs, like most investments, do not guarantee a profit or insure against losses. Furthermore, REITs have high management and transaction fees. However, they do offer liquidity, diversification, transparency, dividends, and risk-adjusted returns. There are around 225 publicly traded REITs in the U.S., which implies you will have some research to do before choosing which REIT will work best for your portfolio. For more data about how to invest in REITs, go to www.reit.com.